having an investor that actually genuinely understands the challenges that are underlying a specific impact thesis or an impact project or a societal problem that needs a solution is creating a competitive advantage for those investors.
Welcome back, everybody. Rich Brubaker, founder of Collector Responsibility, here today with another episode of the Mission Driven Podcast. Through this podcast, I'm speaking to the ecosystem of mission-driven entrepreneurs, innovators, financiers, and those who are just looking out the window, seeing a challenge of environmental, social, or governance, and trying to figure out how can they leverage impact and innovation towards these goals. And so with that, I'm extremely honored to be joined by Uli Grabenwarter, who is the Deputy Chief Investment Officer and Director of Equity Investments for the European Investment Fund. So at the EIF, he oversees impact investing, technology transfer, and venture capital, with EIF being one of Europe's biggest fund-to-funds investment platforms in that space. Uli, it's great to have you with us to share the work that you've been doing.
Thanks for having me. Yes, at the EIF, I am as you said, the Chief Investment Officer. I'm overlooking the entire equity investment business of EIF, and we are basically a massive fund-of-fund investor in the full spectrum of venture capital, private equity, private credits, and infrastructure investing, where we back funds of scale that invest predominantly with a European-centric investment focus. And in terms of thematic approaches, we cover everything that goes from impact investing to sustainability, to life sciences, to tech investing, to sustainable growth investing in private equity, a pretty broad investment spectrum that we are catering for.
Now, for a lot of people that are watching this, they're more used to a traditional impact investor, a small fund. Can you give maybe a size and scope for your activity, but also, in the broader spectrum, like where do you fit into this impact investment ecosystem or, broader sustainability and technology?
I think in terms of size, we have something like 7.5 billion of commitments a year that we make to funds across the different asset classes. And in terms of our contribution to the funding chain of impact investing, we are probably at the most boring part of it, which is we are investing in funds that in turn then have the kind of interface directly with impact projects or impact-driven enterprises, and actually gets the real excitement of seeing business models shaping and creating impact in the market. We are a capital provider in that sense, and we are alongside other investors providing capital to funds that then deploy in impact-driven strategies.
How do you, define within that then impact strategies? Is that the social side? Because you also talk about sustainability and technology. Is it social, or is it something that's like a layer to all of your investments that you're looking at in terms of how you're going to have a positive impact in, say, environmental, social, governance, and other parts?
Actually, we started off in a pretty focused way back in 2013, when we have been predominantly driven by social impact focused investment strategies. We have expanded that over time to the environmental impact type of activities, and today we are branching out into more traditional asset classes like genuine tech investments and the like. Also recognizing that we are in an environment where the boundaries between the different strategies becomes more and more blurred. Coming back to your question, there's one important feature in our investment approach that I think is worthwhile mentioning. When we talk about impact investing, we basically back investment strategies that at their outset have a dedicated focus, a conscious focus on an impact theory of change in the business models of the underlying investments that they're funding.
And then within the organizations that you're investing into, you have 7.5 billion that you're managing. I can't imagine it doing very small tickets, and you're looking to do thousands of transactions a year. What's the size and scope of your average transaction? And are these already businesses at scale? Are these funds that are funding businesses of scale? How do you enter that into that space?
First of all, the assets under management is much bigger than the 7.5 billion that we invest on an annual basis. The 7.5 billion it's our annual investment volume. Our assets under management are somewhere north of 50 billion or so. And our our investment approach in terms of ticket sizes or checks that we are writing for funds that we're investing in, they vary very much as a function of the investment strategies that the funds have and the size of the funds that they need in order to deploy the investment strategies. But across the spectrum that we are covering, we start as low as 10 million as an investment in a fund and can go up to 300, 350, 400 million of an investment in a fund, depending on the size of the undertaking that they are having.
And then what's the size of team that you are leveraging to identify, I guess, qualify, and then manage those investments over time? Because you have a lot of turnover. You must have a large organization to manage that.
Yeah, the EIF as a whole is 750 people, but we have got two business lines. One is the equity business, and the other one is kind of driven by guarantee business for SMEs and loan portfolio exposure. So I'm responsible for the equity side. On the equity side, on the front office investment interface with the market, I have got an investment team with me that has roughly 110, 120 people. And we are dealing with a portfolio of some 1,600, 1,700 funds that we've got on the books already.
And I guess personally speaking, how did you come into the space, into the impact investment space? Were you a traditional banker trying to be a better banker? Were you someone who came from the impact space and leveraged and saw the power to leverage finance? Like, what was your own entry point?
Well, I think I can fairly claim that I've done pretty much the entire journey. I've started off studying investment banking with a focus on derivatives. And my first professional experience was actually in derivatives and maybe contributing to the first generations of hedge funds. Although hedge funds at that time probably are equivalent to saving booklets these days in terms of their complexity. They have been much less sophisticated than what we see today in the financial markets. But I started genuinely in the derivative business, where you basically have a very abstract notion of capital. And then I moved into corporate finance, from corporate finance into venture capital, from venture capital then into impact investing and responsible investing and everything that goes with it. And I've been doing that also from different perspectives next to my activity at EIF, where I'm heading the fund-of-fund investment business of a large organization. I'm also investing in my personal capacity as a business angel, and I'm investing directly in companies, predominantly in the life sciences space.
Impact and responsible came kind of after, derivatives, venture capital, and kind of more traditional finance. Was it, when you came into it, were you trying to fix something that you had been working with for years, or did you see this as a new opportunity and a new asset class that was kind of separate from or leveling up the previous work?
I think at the time it was a less conscious decision. It was more not so much to fix something. It was more about reflecting on what is missing in the landscape of finance. And I was always very passionate about using capital for the benefit of humankind and of society. And I was reflecting at times what contribution is capital actually making to that. And that probably has been in the background more unconsciously been driving my journey from derivatives into more tangible type of use of capital with corporate finance, with venture capital and the like. Looking at the innovation capacity and the potential that venture capital displayed at the time, I was always curious to look further and asking myself what more can be done with capital that actually serves the purpose of progress for humanity. And there, obviously, the kind of narrative that emerged in 2007, 2008 of doing good and doing well was something that was appealing, and that was probably the entry point that seduced me to dig into this.
And when you had that entry point, did you have, say, a specific, I mean, you mentioned, the benefit of humanity. Did you have a specific, because that was also a time when we were talking about carbon and, COP15 in Copenhagen, like there was a real kind of focus around that time around carbon as well, and carbon in business and financing the transition. Was it that was kind of like maybe the first, domain hook, or were you really looking at anything that could, and then so you had a really wide lens at the time?
I think what really triggered it was back in 2010 when I was invited by a project that was led by a university that I'm teaching at IES in Barcelona. And that university has been mandated with a research project for 75 of the largest single-family offices worldwide to analyze how impact-driven investment strategies can be combined with financial return-driven investment strategies, and how they can actually fit together. And the university that I'm teaching at actually contacted me at the time to ask me whether I wanted to lead from the practitioner's perspective this research project. And I got the exposure to all those family offices and their experiences over, some of them already a decade of trying to combine impact and financial return. And that actually was a kind of, probably a 360-degree market view that I could get from that perspective at the time. And that was the start of a fascinating journey.
And you've stayed with the journey, so you must have seen something interesting in those 75 family offices. What did you take away from that? Because like 2008, 7, 8, 10, it's kind of peak impact investment. The first discussions around blended capital, or now they call it catalytic capital. Like, what did you find in that portfolio or through that data that you saw? Like, okay, there's real potential here.
Well, it's funny in a way, because when I went into this research project, I had the then prevailing opinion that you needed to choose between impact and financial return. And I was absolutely convinced that the research project is going to confirm this in a way. And actually, in those 2 years where I did this research and I looked at the investment strategy of those family offices, I actually got converted to this narrative that has been traveling with us for quite some time, that there is no trade-off, and you can have the cake and eat it too, and then basically live on the ideal assumption that we can just invest a little bit more responsibly and save the planet and humanity and everything that goes with it. That was the perspective that I had at the time, and that has been the starting point, and I wouldn't say that I'm at the same point today.
That's awesome. Well, all right, so we're done. Like, have your cake and eat it too. I that make my doctor happy. But with it, I guess like, I mean, I haven't looked at the data as you have in that same sense. But I'm kind of curious. Like, when I hear that, I feel like that sounds great, but we haven't really seen the scale of finance come if we could really have the same level of return. So I'm curious, like, within that research, did you find that actually, like, there's certain sectors or certain approaches that work better, that work really well, and then there's others that don't? And I guess my reference would be, like, say, solar. Solar and batteries 15 years ago made very little sense to the average investor, but now they make a lot of sense, particularly as we have, say, the Mideast oil crisis. Like, the thesis has changed because the economics have changed. Would you agree with that? And then are there other areas that were, like, just more difficult, like working within social causes where you didn't have an immediate measurable return, in part because they didn't know how to measure the return? Like, did that make things more difficult?
I think the main illusion that we had at the time, and that over time proved to be complicated for the impact investment spaces. At the time, we were actually succumbing to the temptation of believing the story of you can have an optimization of financial return and impact at the same time, because it is something that is true for very dedicated segments of business models or projects or alike. And those are the business models where you have a perfect correlation between the societal benefit that derives from an activity and the financial return that is generated through it. And you mentioned the solar panel type of market segment, which in the beginning indeed was complicated because there has been no grid parity in terms of pricing of renewable energies compared to traditional industries. And over time, as technological progress made this grid parity possible, then obviously the entire landscape flipped, and today we are basically in a situation where has been even turned around because of the volatility of the fossil energy sources and the like. But what I'm trying to say with that is that what had made this story possible at the beginning is that the focus was very much on business models and sectors where this correlation actually prevailed. And that led to the conclusion that yes, you can do impact investing in a way that creates societal benefits and delivers at least mainstream market financial returns. It's a very, very appealing narrative, obviously, for the financial industry. But if you look at it from the perspective of humankind as a whole, probably is a little bit short-sighted.
Which leads me to your TED Talk, which is how, I kind of came to know you and how I reached out to you, where you said that, impact investing doesn't work. So can you maybe summarize, like this contradiction where you see like you can have your cake and eat it too, but it's not working. Like what were you seeing at that time that led you to believe like the maybe it's the thesis or it's the frameworks or it's the way that you're setting expectations and measuring them that isn't working?
Yeah, I think the first time that I started to really doubt the system or the concept of impact investing was when we have been a few years into the Paris Agreement and the SDGs and the like. And I mean, we started off in 2015 estimating a kind of astronomical sum of money of 30 trillion US dollars of incremental investment needed to make the SDGs happen by 2030. And somewhere down the road, we made a stock take of this challenge ahead of us. And I was digging into the figures a little bit more in detail and found out that when we looked at the money that went into impact investing in sustainable finance and the like from 2015 to take 2019, 2020, in terms of the money that got deployed in that investment space, we have been pretty much at the pathway on a kind of a pro rata basis between 2015 and 2030 for the 30 trillion of US dollars that we needed to mobilize for that. But then on the other side, when I looked at what has happened to the challenges that have been reflected and portrayed in the SDGs, we didn't make any progress anywhere near this type of amount of money that has been mobilized. And then I thought there must be something that is wrong, this is disconnected, because we found ourselves in 2019, 2020 with a massive amount of societal challenges, environmental challenges that have actually been bigger than what we've been looking at in 2015. And at the same time, we claimed that impact investing has been mobilizing actually the money that ought to be mobilized according to our initial theory under the SDG assumptions. And I said, if that is the journey that we are taking, we are bound to hit the wall at a certain point in time. And that's what led me then to question the concept and said, what is it that makes us derail in that trajectory that we told ourselves we needed to follow in order to get us safe? And I think I came to the conclusion that the main problem that we are facing is the lie about the no trade-off. As much as I think that we can indeed have investment strategies that kind of blend out the trade-off in a way, saying that you don't have to have this trade-off because you can find business models that perfectly correlate. As a society, when you look at it beyond individual business models, when you look at it in the context of the environmental challenges that we are facing, when you look at it in the context of the social challenges that we are facing, the trade-off that we are facing as a society is actually massive. And I came to the conclusion that the reason why we are not making progress on the SDGs as we projected them is because we are in outright denial on this trade-off that we have as a society. As long as we are kind of denying this trade-off, we are not going to make progress with the sustainability goals that we are actually having ahead of us.
Okay. Now, when you say we are in denial, do you mean the finance community? Do you mean us as a wider humanity? And how does that play into this gap that you saw where the money was going there, or maybe not in full, but there was flows going there to the challenge that we weren't actually making the progress that we thought we would?
I think to your first question, I think the denial is universal. I think it's something that is very comfortable and an attitude that we are adopting very easily, that we recognize responsibility and then delegate this responsibility to somebody. And the financial community is a very easy target for that. If it's not the financial community, it's the politics. If it's not the politics, it's the regulator somewhere. If it's not the regulator, it's kind of companies, corporates that are not acting responsibly. But in reality, we need to admit that it starts with each of us. So it is our consumer behavior that is driving as much, possibly not at the same scale, but it is ultimately the financial world, the corporate world is in response to our behavior that we are that we are displaying ourselves, and hence responsibility is a shared concept. Now, when it comes to the question of the financial community in particular, I think it is a concept that the financial service community has adopted, that the fiduciary duty that the industry has is to cater for maximization of financial value. And that is even reflected at many instances in the regulatory framework that the financial services sector is dealing with. And it is a question of how well can we serve the fiduciary duty of ensuring a sustainable planet with concepts that actually reduce fiduciary duty to financial return only.
But if I back that up really quick, and let's just focus on the fact that the financiers have a fiduciary responsibility, doesn't that also kind of part of the problem is also that the frameworks that we were using to engage the financiers were themselves kind of miscalculated. I kind of come back to, I think on some level we had like the gap was also just the tangibility of the challenges between those who were at Impact and those who were, separate and had control of the finance and economic models, like the headquarters of governments and of different areas. And I keep coming back to, like, there's always this gap in tangibility. Like, so a lot of the framework around UNSTGs or even the principles for responsible investment, they weren't drafted in places that are at risk. So like this tangibility gap for me existed. And that kind of bleeds into maybe an investment thesis gap as well. So, if you're sitting, afar from Southeast Asia, where I spend most of my time, how can you accurately understand, like, how to drive your investments to have the maximum impact? Like, is that part of this as well? Like, there's just a knowledge gap. It's not an intention gap, it's just a knowledge gap. And then, aligning that to the fiduciary responsibility, like maybe you're misjudging that because you're looking maybe, too distant or too near in terms of timelines as well.
I think it is more the kind of disconnect between the trade-off that we are facing as a society and the trade-off that we are facing in terms of financial return and impact. I think if we look at it purely from the perspective of investment models and business models that we can invest in, as I said, we can find something that makes us get away with a no trade-off story. But the reality is that the trade-off that we face as a society is something that is undeniable in a bigger concept. Now we can debate on who is going to pay for this trade-off, whether it is going to be the investor community. And actually that was the kind of pushback under the fiduciary duty type of perspective, where people said, well, we may recognize the trade-off as a society, but we are responsible for creating no trade-off returns. So the policymakers, the politics need to take care of the framework that deals with the long-term humanitarian challenges that we are facing. We can debate who is carrying the trade-off and who is paying for that, whether it's politics, whether it's the taxpayer, whether it's the consumer, whether it's a corporate through taxes and things like that. The reality is, however, that somebody in the system needs to pay for this trade-off. And currently, we are in a system where nobody does.
Well, I would argue that populations do, and then as they do, governments do as well. And, we see this happening across Southeast Asia right now, where a lot of government budgets are being blown out to solve problems that that should have been taken care of a while back, but they weren't able to get the funding to secure that until they're forced into probably the most expensive financial position to solve.
Mm, True. I mean, definitely, if you look at it from the perspective of populations making day-to-day experiences, I think yes, a big portion of the human population already pays for it today, but we currently pay more in terms of loss of life quality in certain areas because of drought, because of floodings, because of whatever. But we are not dealing with the kind of invisible damage that is created through our economic cycle, where we basically erode the basis for our future development.
Yeah, and that's also where I come back to like the intangibility of some of this. Like if you're sitting, I know you sit in Europe, but I'm talking to my colleagues in the US, like they don't feel it in the same way that someone does in Southeast Asia, where they don't have the natural resources to solve this through their own budgets, through their own financial ecosystem. Like they still are very reliant upon, overseas funding to make this work, or even grant funding, or the UN to kind of step in on this. But I have started to see that there are foundations, there are family offices now that at the regional level are starting to actually come together and find their own footing to make this to deliver impact more locally. And I'm curious how you see that fitting in. Like if it's a problem of like the distance between the two, like the reality and time and the impact, does actually a regional wealth approach get us a little bit closer?
It does, and I think it does also because investors have generally become more demanding when it comes to their own theory of change and what type of impact they would like to see achieved with the capital that they make available. And indeed, there are a number of players now out there in the market that have migrated from a kind of opportunistic impact investing approach, which was basically looking for the risk return filter first, and then what goes through the risk return filter, you pick the nicest impact that you can achieve, to what I call nowadays being a kind of impact-centric investment approach, where they have their own theory of change of what they would like to see achieved in terms of concrete societal change or problem solving or solution finding. There are a number of organizations that have engaged in that. In the meantime, foundations predominantly. I think the first one that really brought that to some type of scale or of pioneering scale was the MacArthur Foundation in the US, who actually went out with catalytic capital, which is just another term for blended finance. But it is, I think, what was innovative from this investment approach of impact-centric investing is that you don't start with a funding source, but you start with actually what you would like to achieve in terms of impact, and then turn it back and try to develop a concept that makes this impact solution fundable in one way or the other.
Yeah, and I like that in the sense of like it's a narrowing of focus after learning some lessons over time. Like you start off with this concept of impact investing, but over time you actually find like the spaces where you can have the greatest impact, and then you can kind of put your tool set towards it.
Correct. It's narrowing, or maybe not even narrowing. It's just making it more concrete, rather than having an approach where you say, I want some kind of impact for my financial investment. Going towards an approach where you say, you won't get my money unless you give me that impact, and that can, from a spectrum perspective, can be as broad as what we had before. It is just when you come back to the investor and actually show accountability for the investment remit that you've taken on, it's not good enough anymore to demonstrate any kind of impact, but you actually have to demonstrate an impact that you have agreed upfront, and to deliver on that.
Mm. Now, as part of that, do they need to resize their expectations of return up front, or is the idea of concessionary return still palatable to most investors who are particularly the ones that are making progress? I think like are they resizing their overall and saying, look, we were taking up too much, our investment return expectations were too high, therefore impact investment really had a chance, but now we'll reduce this a little bit more, we'll up this, and therefore the thesis makes sense? Or are they still trying to maximize on one end and find concession on the other to kind of find a balance for themselves?
I think it's not so much a question of the return perspective of individual investors and how it has been shaped or adapted to the reality of making impact happen. I think what is the main shift that impact investing currently is understanding, and I think this is the shift that we need to go through also in the years to come, is to move away from capital and financial return creation on capital as being the objective of an investment activity, rather than and moving more into the direction of seeing capital as being a means in a kind of impact investing process. Basically, putting capital at the same level as any raw material in a production process. And the product at the end of the production process is an impact solution, is a solution to a problem that needs to be solved. And capital being a kind of means of getting there. So if I can paraphrase this with an example of funding a company, if you have got any entrepreneur that wants to achieve a certain business model and take away all impact perspective for a moment, because it doesn't really matter. You've got a business model that you would like to make happen, and you need capital for that. If you're an entrepreneur and go out for fundraising, how would you go about your fundraising? If you're getting money for free, meaning philanthropic money or money from your parents or money from your best friends that don't want you or don't require you to pay it back, obviously that's the money that you're going to take first, because you don't have to actually pay for that. You don't have to buy this money with return. But then you will end up potentially in a situation where your business in the startup phase requires more money than what you can get for free. And in that circumstances, you're going to go to the next layer and say, okay, how can I get the next cheapest layer of money that I need to make my business model happen? And so on and so on and so on. And at a certain point in time, you will have no choice but to pay mainstream market risk return optimized returns on the capital that you're going to raise. And the same thing actually happens in the impact investment space as well. If you look at it from the perspective of capital that is needed to make a specific solution happen in whatever circumstances, there are business models that can correlate perfectly financial return and impact, and you can potentially fund them 100% through mainstream capital market. But this is the part of the opportunistic investment spectrum. And then on the other side of the spectrum, you will have potentially problems to be solved where actually market dynamics don't function at all, because the kind of direct beneficiary of the impact that you're going to create may not have any means to pay for that. And in between those two extremes of the spectrum, you find any shade of gray of combinations of those two type of funding situations, where actually impact investing can work as a kind of aggregate of capital with different return expectations, with different impact expectations, and bring them together in order to make impact solutions fundable.
Now, as part of that process, for us to have a higher degree of success or impact or return, however you want to frame it, do the bankers, financiers need to be more knowledgeable about the problems they're putting money into? Like, is it enough to say, I want to be an impact and you are opportunistic? Like, or do you now need to shift into, kind of some domains or build, teams that have domain experience, maybe at a deeper level than let's say 15 years ago, to have to find that balance or to find those opportunities at a greater scale?
Ultimately, I would say yes, that's the case, that we need that. But there is one important step that actually needs to happen before that, which means that there needs to be an incentive for any type of financial intermediary, whether this is a bank or a fund or anybody, to even engage in this. Because if you're a financial intermediary and you are selling investment products, what is your incentive to invest into the deeper understanding of a societal issue or a specific impact domain in order to create the funding instruments that caters for the funding of this domain? If with plain vanilla opportunistic impact products, you manage to fill your order books in the market without any difficulty. There is no organization that would actually volunteer for fronting this expense into knowledge and into expertise if there is no direct comparison in a payoff in their own financial return model. And I think what it takes as the two ends of the kind of client relationship spectrum in financial services develops, if we look at the investment community that gets more and more sophisticated and more demanding in terms of what impact they do actually claim for the money that they're making available. If in the light of this building community of investors, new community of investors, there were a financial intermediary, a bank or a financial service provider that actually made the upfront investment of creating this expertise and then addressed this impact investment community and said, well, we can offer you better than just random return of impact on your investment thesis, because we can even tailor a product that caters specifically for an impact solution that you are keen to see implemented. Then this type of dynamic would shift, because such an aggregator of impact-driven financial solutions would actually have in the beginning a monopoly in the market and actually make massive financial returns on that basis until actually competition develops. But it takes this first mover type of evolution in order to set this off.
Well, I think when you mentioned first mover and the incentives, I'm thinking back, let's call it 5 to 8 years in the movement around ESG and how much progress was made, policy level, at the market level, then baking down into funds and insurance companies and all kinds of, financial professionals. Like there was an incentive to increase your filters to look at, ESG segments. I didn't see that in the impact space per se. And so when you mention incentives and you mentioned this, like which stakeholder should drive those incentives? Is it governments? Is it the markets themselves? Is it, communities, or is it the financiers themselves saying like, look, I want to build this fund. It's solely on this and we'll prove the model over time. Like, I'm curious, who drives that? Because in ESG, I think ultimately it was the capital markets. At the end of the day, there's some reputational stuff at first, then it became okay, climate risk, we want to de-risk, we want to bring that down, we want to de-risk some infrastructure. There was clear capital guidance on incentives, but in the impact space, it feels a little bit more fuzzy. So I'm curious, when it comes to delivering incentives or providing incentives, where does that come from? Is it just more regulators? Is it the stock markets all start to incentivize this? Is it going to come from within the funds themselves?
When it comes to the impact investment community, who could drive this and what incentive could actually make this happen? I think it is like in any entrepreneurial type of activity, it needs somebody who takes the upfront risk to prove this model. And as we speak, actually, there are a few organizations that are out there to try this in different levels of scale. I mentioned MacArthur Foundation already, which is de facto an approach, although they take it from a kind of foundation approach of providing capital for this to happen, to look for solutions. But there are asset managers, and I see a few of them in Europe, and some of them I've actually actively been interacting with and working with, of developing impact-centric investment strategies. And these investment strategies are not meant to just create a vehicle of funding a certain type of impact solution in the market. It is an investment in resources in order to be able to make impact a selling proposition. And the selling proposition being one that can be made both to the investors as well as to impact projects and impact entrepreneurs on the other side. On the impact investor side, the selling proposition is to say, we sell you genuine funding solutions that actually make impact happen in a very predictable way on the other side of the spectrum. And that is something that becomes increasingly appealing to investor communities. And on the impact entrepreneur side, having an investor that actually genuinely understands the challenges that are underlying a specific impact thesis or an impact project or a societal problem that needs a solution is creating a competitive advantage for those investors to actually be part of the funding table of those enterprises.
100%. And that kind of gets back to my earlier question about like the capabilities in the funds themselves. Like, do they need to understand the challenges more closely and be more tangible? Which kind of leads me, like, following up on that, these groups that you're talking to in Europe, are they transitioning from a more traditional fund into this structure, or it's a complete rewrite, a new thesis, and they're building capital around that where the expectations are right-sized to impact?
Most of them are transitioning, and not necessarily for business growth, but for business sustainability in a projection of their business models going forward. Because the kind of opportunistic impact investment approach that we've been observing from 2010 to 2020 plus, meanwhile has become a commodity. Something like 10 years ago, being an impact investment fund has been a rarity, has been something that has created a USP in the market. Today, we've got basically everybody in the market writing impact somewhere in their selling proposition in order to be appealing to an investor community that becomes more picky. And in order to differentiate yourself within this growing kind of lake of or ocean of competitors that are trying to land their selling proposition in impact finance products with an investor community that becomes more and more sophisticated, you need to actually move your own selling proposition to the next level, and that is something that I see happening.
Well, okay, this is going to bring up a concern I have, in that we have this ocean of impact investors, but in many instances, they're really investors, and impact comes second. Like, going back to one of the core contradictions that we talked about earlier, does that present a problem to those who really want to deliver impact? Like, is there now more responsibility to get your model right, and therefore, as the sea goes out and people are shown to not have much impact, is it an opportunity like that you can build a much larger base over time going forward? Like, I kind of feel like we need a culling of that competition where the groups that really understand the impact they're delivering, putting money towards it and actually measuring and showing real results, they should be rewarded, as others who just kind of used impact and name only, as they just use it as a name only. They didn't actually invest behind it.
Yeah, I think this is you're touching on the very complexity of the financial market spectrum, because as much as we can see on the side of impact investors, funds and those that invest genuinely in impact projects, as much as we can see serious and less serious people in that space, you have the same thing in the investor space that fuel those funds and those intermediaries. And obviously, if you become more sophisticated in terms of the impact challenge, and if you try to integrate the trade-off that we've been discussing previously, and you have not a solution of having this impact being this trade-off being catered for by the right community, you basically have to place this trade-off decision with the investors. And that actually leads us back to the discussion that we had at the beginning of this conversation, where you then need to find investors that are ready to forego financial return for impact. But I think this is the very important paradigm shift that I'm seeing in the market, is that we are in the process in the impact-centric investment space to grow beyond that, where we push the trade-off on financial return versus impact to one specific investor community only. But we actually diversify that across the spectrum of different funding providers that have different concepts of trade-off between financial return and impact in their own investment preferences. And because we have this diversity, we have a broader spectrum of how we can actually cater for impact finance solutions that have in the past not been possible.
What's behind that maturity or that maturation? Is it that more people just understand impact investment principles and there's enough cases out there that they can learn from, be inspired by, copycat? Or is it that the problems that we've been talking about for 15 years are now here?
Yeah, I'm not a big believer that we've become any smarter, but I do believe that the impact of what we are doing to our natural resources, that we are doing to our planet, that we are doing to our living conditions, the negative impact has moved in with us. And you can declinate that in all type of feedback that we are getting from the environment that we are living in. You can take the long-term perspective, and some people may be sensitive that the kind of ice caps of Antarctica are melting and the like. And for others, it is going to the fuel station and finding out that the price for 1 liter of gas oil has doubled over the last 3 weeks. Everybody has their own triggers and indicators that speak to them. But the reality is that we have today a much bigger part of the population that is ready to admit that we are not in for an easy ride if we want to make this.
So looking forward, where do you see this going? Do you see more impact-oriented funds coming to scale? Do you think that actually, where before we weren't meeting the needs of the SDGs, that now actually there's enough people catalyzed we'll start to catch up? Like, what's your general feeling, and what kind of gives you hope around the idea that the financiers can come in at this time to make a lot more progress?
I think on one side, I think it is indeed scale that there will be more interest and hence more capital available in the impact investment industry, and also the spectrum will widen because of the sophistication of investors and the kind of emergence of players in between that tailor impact solutions on both sides of the spectrum. But the second part that gives me hope is that I think that we will see in the years to come a very strong diversification in the ways how impact is actually monetized, because so far we have been very much living on the concept of a kind of monodimensional buyer-seller relationship, where somebody who wanted to have impact or a product with or without impact went out there and looked for a seller and settled the price. And as we moved on in this journey of responsible investing and frameworks that catered for environment, we have been pretty good in trying to integrate externalities more and more into the kind of business processes. But this still is something where actually the buyer settles the internalization of externalities in the product cost and things like that. But as we move beyond that, and as we move into the area of impact problems or challenges that we need to solve, that cannot be solved through outright market solutions, where you have a kind of a buyer and a seller that settle everything that is involved in this food chain. We need to also have more sophisticated ways of monetizing the societal value that goes beyond the financial return generation within the balance sheet of a company or in a product. And I think also sophisticated investors that are keen to contribute to the value creation in their investment targets can play a very active role in that.
Okay, now if you were speaking to those investors who are keen to get involved, what would be 2 or 3 pieces of advice you'd give them to get a little bit further in their path?
I think the first one I would say is focus. Because if you want to add value to anybody, you need to understand the value that you're proposing. I think it's if you ask me for my advice, if I look at all the impact investment funds and service providers and intermediaries at large that are engaged in this spectrum, coming back to what I was saying before in terms of increasing the sophistication with what they are trying to put forward as their own selling proposition. This type of expertise that they can insource, that they can integrate in their own business models is going to give them that competitive advantage.